Hi, everyone. I'm Tom Lydon, and welcome to the Monthly Income Podcast from NEOS Investments. We're on a mission with this podcast, and what we're trying to do is a few things. And this is what you can expect from us on a regular basis. We're going to share views on the current markets, what's happened in the past recently. We'll also give some insight on what we're hearing from financial advisors. We're talking to them all the time, and especially as we're at the early stage of 2025, they've got a lot of ideas. We'll also highlight some important things when you're considering portfolio implementation for this next year, especially considering the economy and current market conditions. And then most importantly, at the end, we're going to share monthly portfolio building ideas. It's always good to be up to speed with thoughts, not only concerning the economy and markets, but also investment strategies. So I'm really thrilled to be joined by Garrett Paolella and Troy Cates, who are the co-founders of NEOS. Gentlemen, great seeing you.
Great to see you too, Tom. Thanks for being here with us today.
Thanks for being here with us, Tom. Appreciate you.
Well, I've been looking forward to this, guys. And look, NEOS has just been storming with popularity among investors and also financial advisors. Being a global asset manager, focusing on innovative ETFs that especially offer enhanced option strategies to seek tax-efficient monthly income. If you wouldn't mind, Garrett, talk about that, because that really is your differentiator.
So here at NEOS, we really think about, as you are allocating your income portfolio, trying to derive either monthly, quarterly, annual income, we really think about how much taxes impact the investor. And so are there ways to get core exposures to, call it the S&P 500, core fixed income, treasuries, right? Any area of the risk allocation bucket within your portfolio, but to do that with generating monthly income on a tax efficient basis, that's really our core focus. We want to make sure that net after tax return, that yield that your client is getting, is going to be as close to what the gross yield ultimately is. So at tax time, they're not getting a huge surprise that a lot of what they just generated and the risk they took over the last year is ultimately going to get paid out to the government.
Yeah, and really, you're talking about this last year, Troy. We are, towards the end of the month, going to get reporting from all the ETF issuers that kind of play in this space to really find out how efficient that income is, isn't it?
Yeah, no, it's really important for us, as Garrett mentioned. So as we start to get those numbers coming in towards the end of January for what 2024 looked like and how that disseminates out, it's really important that people who are invested in these products, looking at these products, really understand the tax efficiency. There's a lot of products out there in the space, a lot of big distribution numbers being thrown around. But in the end, you want to look at that number and see, how did that work into your total return? And how did that also work into how your final distribution and what your taxes look like?
Yeah, really, really good points. All right, guys, let's get into it. We had another great year in the equities market, Garrett. I mean, back-to-back years of up over 20%. That hasn't happened since 97 and 98. I mean, a long time ago. And what are the prospects for the future as we look back? I mean, are markets frothy? What are investors to do? What are financial advisors to do?
Listen, that is definitely the crystal ball question. As we can see, right, back-to-back years, and I think asset allocation in general is what's, paramount to that. So as we think about a client's allocation having some equity exposure, a lot of equity exposure, depending on their risk tolerance, that's going to certainly drive a significant amount of where an investor is going to be allocated in these types of products and these types of markets. But I think the one thing that we're looking at is, right, you have a new administration coming in that, if you look at the last time they had taken office, right, they spent 4 years pressing as much GDP growth and expansion and also as positive of equity markets and bond markets overall as they could, right? So you definitely have a new government coming in that is very keen and focused on pushing the economy overall, into it. But one thing that I think you can expect is very much times of unknown volatility, right? Unexpected volatility, where there could be a tweet from this administration that certainly sends a immediate and quick volatility shock into the market, which, if we go back to history, that always looked as a great buying opportunity through those 4 years. But I think what we're looking for is certainly the Fed containing interest rates and an inflation target, closer between a band that they're going to be comfortable with this administration looking to really be positive within the overall economy and growth, but with certainly your speed bumps of volatility that can come and happen, which would always support, right, a solid asset allocation plan and ways to kind of mitigate or take advantage of those markets and volatility shocks.
Yeah, and speaking of volatility, Troy, I mean, we've seen volatility in the fixed income side as well. The Fed's signaling that they're going to have a couple more rate cuts coming up. We've seen rates in the last year that are something we haven't seen in 20 years. It's nice to get paid on short term. It's nice to get paid in money market funds, but with what the Fed's signaling, we may not get paid as much in the coming year.
Yeah, so the Fed has already started, as we all know, cutting rates. What does that look like for 25? Right now, they're the market's kind of factoring in 2 more 25 basis point cuts. I think earlier in this year, we were expecting more than that. And so as we've seen towards the end of the year, the yield on the 10-year moving higher, bonds selling off, we're getting back into that cycle of, wait, is the Fed going to look at this and say, yes, we're still going to do 1, 2, 3 more cuts? Or are they going to say, wait, let's pause and hold off while we wait and see what happens with the market? So it's definitely something we're watching. We've also seen the equity markets volatility play into that. We saw spike in volatility back over the summer. We've seen volatility rise into the end of the year. So it's something we pay a lot of attention to, specifically around this part of the market, because it affects how we manage option portfolios and what we're doing when we're rolling those portfolios, because volatility plays a lot into that.
Yeah, guys, at the beginning, we talked about conversations you folks are having with advisors. And as we talk about equity markets and we talk about fixed income markets, what are some of the anecdotes that you might be able to share? I mean, this is the time of year where advisors are having end-of-year meetings with clients. They're reviewing their performance. They're reviewing portfolio positioning and strategy for the coming year. Garrett, what are some of the things, especially in the equity side, that are jumping out at you?
Yeah, so I would definitely say overall, the search for income, right? As rates are coming down and the Fed's cutting off of, like you said, rates that we haven't seen in 20 years. Clients also got comfortable with very high rates relative to this kind of last decade or two, right? So as they're looking at either equity strategies, fixed income strategies, but talking about equities first, right? Ways to augment their portfolio and get more yield than just what you're getting in a maybe dividend paying stock portfolio that's yielding you 150 or 200, maybe 250 basis points. And so a lot of advisors we're speaking to are looking to products like our covered call strategies, that are generating you anywhere, depending on the product and the underlying index, a 10 to 15%, maybe 17% yield as ways to augment the fact that they're taking equity volatility and equity-like risks within that portfolio, but certainly getting paid, through the options premium, to add into their portfolio, because as they're seeing their cash, their fixed income, their ultra short duration start to come down, clients are still expecting to be able to get that yield to live off the fact that inflation might be slowing, but we already got those expenses over the last several years, right? The cost of the pump hasn't come down significantly. Groceries are more expensive, and so the costs are still ultimately there for clients to be able to meet their living needs.
And Troy, as we talked about having back-to-back 20+% years and not seeing that for a long period of time. I mean, look, we'd love to be optimistic. We'd love to see another positive year for the market. But specifically to the equity-based index products that you folks provide, I think what Garrett was saying is it's nice to be able to have that additional yield, nice yields at the S&P 500 level, but even better when you look at the NASDAQ or the Russell 2000, kind of getting paid to wait for continued advancement in those areas of the markets, right?
Exactly. I think if you think about it, just like you were saying, we're coming off 2 years of the S&P 500 being up around 25% each year. That does not happen that often. So when we see that, I think a lot of people are looking at it and saying, okay, going into 25, are we going to see a year where the market starts to cool a little and maybe we have a more normalized gradual grind higher? And when you're looking at products like ours, specifically on the equity side with the high income option overlay products that we provide, you can get paid on a monthly basis while you're waiting. So whether you want to have exposure to the S&P 500 or the NASDAQ 100 or the Russell 2000, it's one of those spaces where you could get paid, hold on to the underlying equities and underlying portfolio of those indexes, but still have the option portfolio on top of it to give you a tax-efficient monthly income.
And Troy, have you heard from advisors? I mean, again, you're talking to them all the time, but it wasn't that long ago where a 60-40 allocation was the prudent thing to do for your clients. I'm just hearing that people are abandoning the 60-40 strategy. They're looking at being a little bit more creative. What can you share in that regard?
I think the advisors that we've been talking to have definitely been steering away from the 60-40 methodology. And I think they're looking at it as more, where do they need to provide income for their clients? How much income? How tax efficient does it need to be? And I think that's where NEOS really comes into play. Sometimes they bucket us into whether it's an equity or fixed income or ultra short duration, part of that overall 60-40 model. But for us, we're also can be slide right into the alternatives bucket where people are starting to say it's not really 60-40 anymore. Maybe it's 50-30, 20-20 going to the alternatives where bringing in option income from a different source other than traditional fixed income is where I need to be able to provide the income needs of my client.
Great point. What would you add, Garrett?
Yeah, I actually would second that. I was just talking to a CIO of roughly a $40 billion asset manager, and they have several advisors on their platforms. They have tens of thousands of clients, and that was a big topic of conversation, was enhancing the overall asset allocation. So whether you call it a 60-40 or just the traditional vanilla, equities and fixed income, and yes, varying your degree of maybe what your cap exposure is on the equity side or your duration, or credit worthiness on the fixed income. They're now starting to think, how do I enhance this for my clients? And one big conversation, which is really part of what this podcast is about, right, is monthly income. How are these clients able to generate income off of their portfolios, whether that be while they're still working and passively generate that or actually living off of that? And so I think we're definitely having the same conversations that, this CIO is really keen and focused on ways to enhance the asset allocation coming into 2025 and saying, okay, great. There's been a tremendous amount of product issuance in the marketplace over the last, several years, but really we've seen track records, we've seen kind of proof in the pudding and the performance of like how these types of product sets and what products out there overall can help clients achieve their end, retirement goals or their income needs. And so that's been a real big topic of conversation, is always taxes. I think everyone always wants to mitigate a tax, and everyone would always like more income. So those two things always are kind of the key blocks that are driving these, these conversations.
Yeah, not to go down a rabbit hole here, but there's hundreds of billions of dollars in index-based fixed income ETF strategies out there. We know that a lot of active managers were producing products in the fixed income space, trying to juice that return a little bit, try to get a little bit of alpha. But boy, with what you folks have done, especially with your fixed income ETFs, by being able to provide that options overlay strategy to get even that much more of that dividend yield, it's kind of night and day compared to traditional fixed income ETFs.
Yeah, I think what we're trying to do is a little different. So we're still trying to take that underlying holding of core aggregate bonds or high yield bond portfolio or an ultra short duration portfolio, and looking at how we could pair an option portfolio on top of that and overlay that on top and pair the risk parameters for both of them. So we're not inherently bringing in too much more risk into the portfolio, but we're bringing in more income. So we're enhancing the income on top of whatever those underlying portfolios are doing. And we're enhancing that income by sourcing that from the equity markets, using S&P 500 index options to enhance that income on top of the fixed income portfolio. So definitely a little different than what others are doing when they're trying to pick specific sectors or specific bonds and try to get a little bit of alpha, as you were saying. For us, we're sourcing that from the option market, and it really works nicely when you think about how that pairs with the tax efficiency and how that pairs with making sure you're getting consistent monthly income.
Garrett, talk briefly about the futures market and the size and liquidity, but most importantly, how are these strategies affected when rates are lower? I mean, we've had some cuts already. We've got some further cuts going on. Are the option strategies affected by lower rates?
In the options that we're using, they're not, right? Because they do have an equity bias to them. So you tend to actually get a little bit more volatility in a rate cut environment as well, or a rate hike. So when there's changes within interest rates overall, that could add all asset class level volatility. But for us, we actually don't lose the level of volatility which derives the income as rates come down. So if you're invested potentially in a core fixed income or a treasury product or else, yes, those underlying core holdings always get reset with the underlying interest rate environment, but the options market, not so much. So do you want to generate an extra 1 to 1.5% above treasuries or 2.5%, say on core fixed income? The options market will allow you to ultimately do that regardless of where interest rates are. So these are great products that investors have been looking at specifically as rates have come down, because they're able to get that additional, yield and income. But also, the one thing I'd touch on is the tax efficiency. So those options have a very much tax efficient structure to them. And so when you think about the options income component, if you're in the highest tax bracket, let's take the most affluent, that's going to bring you into a tax bracket of roughly just under 27%. So when you think about long-term capital gains at 20, ordinary income at 50, 52%, depending on the state you live in, the fact of being able to generate these income in a tax-efficient manner, as opposed to just your core fixed income by picking a different bond that's still taxed at ordinary income, but taking more risk, is a really great and innovative way to think about how you're generating that monthly income in a portfolio.
It's all about the monthly income, guys. I tell you, as a proud American who just signed up for Medicare, I can't tell you how important that monthly income is. Let's move on. You guys have been really innovative by listening to advisors, by listening to investors about what type of products they're looking for. And it's amazing. You've got a regular cadence of new products that have come to market. Let's dig in. Most importantly, I want to talk about your Bitcoin product. Troy, talk a little bit about it and how is it different from other ETFs that are out there?
So yes, this one is our Bitcoin High Income ETF, ticker BTCI. This one we were really excited to get out into the marketplace. This one, you're getting long exposure to Bitcoin through a couple different ways. One, through the ETPs that were brought to market in the past year. We're long up to a 25% position in one of those. And then we use the SIBO index options on Bitcoin to get the other long exposure synthetically. We could dive into that, where you're basically selling a put, buying a call with same expiration, same strike, to get that move, a 1 delta move in the long Bitcoin. And then on a monthly basis, we're writing calls very similar to how we do in our equity products to bring in additional income. And with that, we're able to provide a high monthly income while you're holding a long Bitcoin exposure. So it's a really exciting product. We've had some nice flows into it, some really nice performance since we launched it, given the move in Bitcoin since the election in November through the end of the year.
Garrett, we've seen a lot of money flow in very short period of time. I think most advisors, if they have not allocated for their clients, here's an opportunity where maybe they can put a small allocation in there. But the biggest thing, and just trying to pull this out of you guys, talk a little bit about the income that you've received so far on a monthly basis through this product.
Yeah. So listen, of course it's Bitcoin. So this is still for the higher octane allocations, but we're able to do that in a way that we are lowering the volatility by doing this through the option strategy. And listen, let's just give a quick frame of reference. Volatility on the S&P 500, is roughly between 15 and 20 on average, right? So today we're probably sitting closer to 16. Bitcoin on average now is 60, right? So that significant degree of additional volatility allows you to generate income in this fund to the tune of roughly 25 to 30% per year. So right now we're really looking at doing the covered call overlay using those Bitcoin options and seeking to kind of generate that 2 to 2.5% per month, but giving exposure to Bitcoin and participating with the growth of Bitcoin, to that. So
I know in talking to some advisors, they've had clients that on their own went invested in crypto. They had set up a Coinbase account or whatever. now with the proliferation of crypto-related ETFs, innovative strategies like this, it's a great way to get them back on the reservation, back into their custodied accounts. But with that income kicker that really you can't get in that many places, there are a lot of advisors who now can bring that Coinbase money over or money that might be on other platforms and get that part of the client's overall strategy. Troy, you hearing that things like that are happening?
Yeah, I think some of the clients that we've talked to, missed owning Bitcoin at 20, 30, 40, 50,000. And they're looking at it now saying, do we invest now? Their clients are pushing them. They want to be invested. They want to have some sort of an allocation to it. They don't want to be left behind. But for this product, I think a lot of them are looking at it and say, hey, if I could buy this, and even if Bitcoin pulls back, I'm still getting paid on a monthly basis. And if it moves higher, we're still getting paid on a monthly basis, and we might not capture all of the upside, but we're going to capture a good portion of it. This might be a product that might fit their clients' needs. So they have that underlying Bitcoin exposure. They could get paid on a monthly basis. It could add to that monthly payment that they're looking at from wherever their equity or fixed income portfolios and help supplement some of that income as well.
We want to talk about Newsy, your longest tenured ETF within the NEOS family. That's something that you've been managing from the start. Talk a little bit about Newsy, especially the great year that it's had.
Yeah, so Newsy is the NEOS NASDAQ 100 Hedge Equity Income ETF. It is actually focused on giving you that exposure again to NASDAQ 100, but doing it in a hedged equity manner. And so I think, as most investors know, hedged equity tends to be a total return. Well, again, we're about tax efficient monthly income here. We're talking about monthly income on our podcast, and so what we want to do is give you that hedged equity exposure for the clients that aren't looking to take a full-on equity allocation, and do that to generate still, again, a tax efficient monthly income. And so for Newsy, that's a great allocation as ways to either downshift some of your equity allocation. We see a lot of advisors also mixing it, pairing it between a fixed income and an equity allocation to, again, as we've seen that asset allocation 60-20 expand, it's saying, listen, I'm overweight bonds, or as my bond yields are starting to come down, I need to find other bond-like alternatives, to be able to play into. And so Newsy could be a great way to have equity exposure, knowing that you have a hedged or some principal protection in the product, but generating that kind of 8 to 9%, per year in a tax-efficient manner, which is going to be above, bonds, but maybe below some of the cover call products we offer, but you're taking that less equity risk to do it.
Troy, one of the big strategies advisors have implemented in the last 12 months is started to go longer duration with a lower rate environment and the prospects for lower rates. It makes sense trying to maximize the yield, but also the ability to have some market appreciation with that type of move. Your latest venture into this area, TLTI, talk about that, replicating the 20-year treasury.
When we started bringing out ETFs for NEOS back in August of 22, one of our first ones was an ultra short duration product. So CSHI, 1 to 3 month T-bill with added option income. And we looked at it and we always knew we wanted to get a longer duration. So as time went on and we started to see the shift in the market, we really wanted to get a longer duration product out. So TLTI is a 20-year plus treasury underlying with an added option overlay on top of it. Very similar to some of our other fixed income products, basically using an S&P 500 index option put spread overlay to bring in additional income. This is a product that's rolled on a weekly basis to bring in that added income, but pairing the risk of the 20-year plus treasury with the option portfolio to as close as we can, so we can give you that added enhanced income on a monthly basis over what you're getting in the 20-year treasury.
And finally, guys, not resting on your laurels, you've got a new launch that's coming up. Garrett, talk about your real estate high income ETF.
So this product fits within our equity high income space. So IYRI is going to be coming out very shortly, and we're looking to give you exposure to the real estate market. So think about REITs, which has been historically a income allocation for a lot of the endowment or a broader asset allocation. Well, we're bringing into it the ability to, again, do a laddered covered call strategy on top of it with using actually real estate options. And so we're giving it a core exposure to REITs, but going to be a much higher degree of current income being able to be generated off of it. So as you think about like NEOS as a whole, as we think about just the monthly income podcast, right? For us, we want advisors, we want investors who espouse their views on how to create monthly income, how to compound wealth. And so we're giving more exposures throughout, whether we just talked about equities, core fixed income, Bitcoin, now soon coming out, real estate. Espouse your market beliefs, your views, and where you want to go, or hold a diversified, enhanced core asset allocation. And NEOS products will help, focus on that with that degree of income and tax efficiency.
Yeah, and the tax efficiency thing is key, as we talked about earlier. In the coming weeks, we're going to be able to judge how all the ETFs that kind of are in this space are performing. And I just venture to say that there are some pillars in this space that have garnered a lot of money, but I don't think that they necessarily have the tax efficiency that most of the NEOS ETFs have. And that's something that an advisor needs to consider. It requires a little bit more work, but it's worth it. And most importantly, with you guys, you're sharing feedback that you're getting from advisors too. And we'll be talking more about this in the coming months on these monthly income podcasts. So guys, look, before we go, and this has been fantastic, talk a little bit about wealth building ideas. And Garrett, maybe you can start. What would be one of your biggest ideas for advisors and investors as we look at 25?
Yeah, so we've touched on it a little bit throughout today's podcast, but really it's we're big fans of how that compounding interest happens. How are you able to take a net after-tax return and be able to reinvest those proceeds or utilize the income to be able to fulfill your daily needs? And so the wealth effect that actually comes from being able to consistently look at, compounding returns in your overall portfolio, not even talking about the NEOS products, just talking about that concept in general and the importance of actual taxation. I don't think a lot of investors and advisors, more investors, because advisors, I think, do a great job at really trying to educate their clients, on this, but the average investor that's coming is really saying, oh, this product looks great. It's got a great total return or yield. It's hard. Once you get to April, now you're saying, okay, how much of that am I actually paying out in my brokerage account? And so I think that's a really big importance for investors to think about is what is this product going to do for my portfolio after April 15th?
Troy, what would you add?
Listen, I think Garrett covered it really well. Compounding interest, being able to look at that tax efficient monthly income and how that could compound very quickly on a monthly basis, on a yearly basis, and look at how that helps your overall client's portfolio and their needs in the end.
I would say, and you guys taught me this over the years, I've known you for a long time. I've invested my own money in these products. When you talk about options, sometimes people get a little nervous. It's not the options market that it was 10 years ago. The liquidity, the amount of volume, the efficiency, the disciplines that you guys provide, it's fantastic. And when you look at the tax efficient income, hey, I happen to custody at Schwab. I know when I get the 1099s, they're going to be a certain block where it's going to be fully taxed. There's others that's going to be more tax efficient. It's not that difficult. And the reporting that you folks as an issuer do with the platforms is fantastic. You do all the work. So as an advisor, it's pretty easy to understand, and it's really easy to share with your clients. And most importantly, the effectiveness of that tax efficient income really comes out around tax time. So you get a little bit of added pat in the back at that time of year when it's difficult for some to kind of write those checks. Is there anything else you guys would add about the education of the tax efficiency? Because look, good things don't always come without any effort, right?
That's correct. I mean, things take effort overall, but these products, just overall access to different products for your clients' portfolios, for your own individual portfolios, has been growing leaps and bounds. I mean, there's thousands of different ETFs alone to pick from, let alone other funds and separate accounts. And so as I think about, overall asset allocation and talking with advisors, right, it's kind of staying steady, having a plan, making sure there's a diversified and well thought out portfolio, that is there. So as you see volatility shocks, as you see changes in rates, right, those are not going to be a monumental, impact, but there's so many products right now that you could choose, that NEOS offers across all of our asset allocation and other products that can really help investors get to their income goals and the money that they need to live off of on a monthly basis.
Gentlemen, this has been fantastic. Thanks for letting me be a part of this. I'm really looking forward to getting together with you guys every month for this podcast. Monthly income is key and critical to a lot of investors, and you're just doing a great job in helping people get all the essence of the opportunities that are out there. You're also fun to hang out with too. So looking forward to next month, and thanks, guys.